The Japanese yen has plummeted to a 3-decade low against the dollar this year, leading the government to intervene in currency support for the first time since 1998, and most possibly more than once. These were bold actions for a country that trading partners have long criticized for accepting, if not encouraging, a weak yen in order to help its exporters. So, was the intervention successful? Why did the government take action? And will there be more yen buying? The day of the government's currency intervention, September 22nd, began with all eyes on the Bank of Japan. The U.S. Federal Reserve had just lifted its key interest rate by 0.75 percentage points and provided a more aggressive prediction for future hikes than the version released 3 months before. The Swiss National Bank was expected to raise its benchmark interest rate, while the BOJ would maintain its ultra-easy policies, leaving Japan as the only country with negative interest rates. Not only did both of these things occur, but BOJ Governor Kuroda Haruhiko underlined his firm commitment to easing at a news conference following the policy meeting, saying, "The Bank of Japan will not raise interest rates in the near future. Rather, we will further loosen policy if needed." The yen fell further as the growing monetary policy divergence between Japan and other major central banks was emphasized. The Japanese currency had already lost over 20% of its value in 2022 against the dollar, as numerous central banks tightened policy earlier in the year. As Kuroda concluded his news conference, the yen fell below 145 against the dollar, a level not seen since 1998. The dollar-yen pair then abruptly reversed course, falling from 145 to 140. Soon after, Finance Ministry Vice Minister Kada Matsudo stated that Japan had intervened by purchasing the yen for the first time since 1998, adding, "The government has just taken decisive action." From August 31st to September 28th, Japan spent around 2.84 trillion yen, or $19.6 billion US, intervening in currency markets. The action occurred as individuals in Japan were facing increased import prices as a result of the weakened yen. Import prices in yen are 41.8% higher on average than last year. Economist Kumano Hideo notes, the yen started drastically weakening from March. If the currency exchange rates goes from 115 yen against the dollar to, say, 145 yen, that pushes up import prices by about 30%. Shoppers in Japan are complaining about price increases as a result of the consequences. The Kishida administration must address the price risk or risk losing a fall in its approval rating, according to Kumano. The government has gone to its last resort in terms of forex levels, intervention. An intervention just before the yen fell below 145 against the dollar was intended to alert market participants mindful of the level. Every time the yen falls below a certain level, the government will launch a fresh line of defense. It's all designed to hold yen weakness at bay for a short period of time each time. Indeed, the intervention on September 22nd only temporarily stemmed the yen's decline. The dollar-yen exchange rate did return to around pre-government levels. However, the yen fell further, with the greenback breaking below 149, a 32-year low for the yen. The government intervened to boost its currency. Buying yen reduces the amount of yen in circulation and raises its value. On the other hand, the BOJ's ultra-easy policy has the reverse effect. Monetary loosening increases the amount of money in the market, decreasing the value of the yen. Buying the yen while the BOJ maintains its easy stance is like pressing the gas and the brakes at the same time. The government understands that intervention has limited consequences. That is why it launched a surprise strike at the most effective time, immediately following all significant monetary policy decisions. You use this approach when you know your battle strength is depleted. The government's ammunition may be limited depending on Japan's foreign exchange fund's special account. This is where the government obtains funding to intervene in the currency market. Kumano notes, there are about $1.3 trillion in this special account. So if you elevate just that figure, it seems like the government has an abundance of funds. However, because most of that money has been placed in items like U.S. government bonds, the government's liquidity may not be all that high. Given the circumstances, I would call the scope of currency intervention audacious. He argues that officials were allowed to be bold because they were unlikely to continue intervening for a lengthy period of time. So how long can the yen buying continue? Experts believe the government will continue to intervene for several months, because it believes the yen only has to be maintained from weakening until the U.S. economy suffers from its own rate hikes. In a few months, there will most likely be concerns about the U.S. economy, and the Fed may stop raising interest rates. If this occurs, the currency market will experience pressure in the opposite direction, favoring a stronger yen. If you believe the market will finally come around, intervening just before the turn will be the most beneficial. Currency intervention isn't the only technique the government employs to control prices. Prime Minister Kishida Fumio has stated that his cabinet will put together an economic plan to combat inflation. However, if it is thought to be more than the nation can afford, that policy assistance might further devalue the yen and increase inflation. He uses the recent situation in the United Kingdom as an illustration of how concerns about fiscal stability might lead to currency devaluation. The Truss administration proposed tax cut ideas to assist its citizens in dealing with rising prices. As a result, the government would have to borrow more, causing investors to sell the British pound. The pound fell to a historic low against the US dollar. The ensuing economic panic was so severe that the British government was forced to abandon its tax cut ambitions. If the Japanese government can find a method to prevent currency depreciation, it may come down to Kuroda's replacement as BOJ governor. So to speak, the Kishida administration possesses a trump card. The yen is dropping because the Bank of Japan has stated that it has no intention of raising interest rates, even while the US does. However, if the governor of the Bank of Japan changes, the dollar-yen pair may move in the opposite direction. Kuroda's term as governor will expire in the spring of 2023. As the budget for the following year is released at the end of the year, the public's attention is drawn to the government. The administration may aim to halt the yen's slide by announcing Kuroda's successor at that time. With the global currency market volatility, the Japanese government and the BOJ will need to tread lightly regarding the yen's value. Following the move, the yen and bond yields jumped, surprising investors who had expected the BOJ to make no modifications to its yield curve control until Governor Haruhiko Kuroda stepped down in April. The BOJ opted to let the 10-year bond yield fluctuate 50 basis points on each side of its 0% goal, a broader band than the previous 25 basis points band, in an effort to resurrect a dormant bond market. However, the central bank maintained its yield target and stated that it would significantly expand bond purchases, indicating that the action was a fine-tuning of existing ultra-loose monetary policy rather than a withdrawal of stimulus. Maybe this is a baby step to test out the strategy and see where the market reaction is and how much it's reacting, said Bart Wakabayashi, branch manager at State Street in Tokyo. I think we're seeing the first toe in the water. During a two-day policy meeting that ended on Tuesday, the BOJ kept its YCC objectives intact, which were set at negative 0.1% for short-term interest rates and near zero for 10-year bond yields. The BOJ also said that it would increase monthly purchases of Japanese government bonds, or JGBs, to 9 trillion yen, or $67.5 billion, from 7.3 trillion yen before. Through these steps, the BOJ will aim to achieve its price target by enhancing the stability of monetary easing under this framework, the BOJ said in a statement, signaling that the move was aimed at prolonging YCC rather than phasing it out. According to board member Nakamura, the BOJ must sustain its ultra-easy policy. Following the ruling, the benchmark Nikkei share average sank 2.5%, and the dollar dropped 2.7% to a 4-month low of 133.11 yen. The yield on a 10-year Japanese government bond, or JGB, momentarily reached 0.460%, close to the BOJ's recently imposed implicit maximum. Meanwhile, the markets are already wondering what the BOJ's next move will be as Kuroda's term ends, and inflation is projected to linger above its 2% target far into next year.